Today, we're going to be talking about annuities. Yes, that four-letter word, but in particular, we're going to be talking about the taxation of these annuities. A lot of my clients have these. A lot of people in retirement have annuities of some type. And I want to get very specific about non qualified annuities. So, this is funded with after tax dollars, not in an IRA. They have very specific tax implications. And I want to talk about the pros and cons of that. Let me bring in my non-tax expert, Tony Shore. Welcome to the show, Tony. Um, yeah, four-letter word. We're going to talk annuities today.
Oh,
What do you think?
or taxes. Well, that's a 5-letter word, but uh,
Yeah,
yeah, but
two
annuities.
four-letter.
Annuities
Mm,
is the A word. That's a dirty word. Annuities. It is like a 4-letter word. And I have a question for you because I get what non-qualified and qualified means. We talk about it a lot, but annuities is an area that I'm not sure about how that works. So I've always heard people pitching, annuities, and it can grow tax free.
yes.
But does it come out tax free? Are some annuities like if I just go, I hear a lot of financial advisors touting annuities for safe money, get 5%, get downside protection, your principal's protected, and you can
Yeah.
get up to, either 5% or up to 10% in the market if it's a fixed index. But are those annuities all taxable when I need that money to come out in retirement?
Yeah. I want to talk about that because it's a big, well, some you'll even have some insurance agents say these are the greatest tax vehicles too. They're better than everything else. And I don't know. I'll let the viewer decide,
Sure.
but I'm going to go through the pros and cons. And you're right, Tony. They do have a lot of benefits. So everyone talks about fixed rates or indexed. Even
Sure.
variable annuities have upside with some death benefit protection, so on and so forth. I don't want to get into those today. I'm going to talk specifically if you have these or you're thinking about buying one. I want you to understand this is a tax decision as much as it is an investment decision. So let's start with the biggie, which is so this is not in an IRA. So let's say you have $100,000, Tony, and you
Okay.
put it into an annuity outside of an IRA. So that's called a non-qualified annuity. And by nature, by law, by design, these are tax deferred. So earnings will grow tax deferred until you actually take a withdrawal from that annuity. So and that compounds, and you don't get a 1099 from the insurance company at all until you actually take money out. So
Okay.
let's say you put 100,000 in and it makes 5% return that year. A year later you had 105,000. What kind of tax liability do you have? Nothing. It's tax deferred until you take it. Much like an IRA, a non-qualified annuity has this tax deferral. And this is what a lot of insurance salespeople will say is the greatest thing because you can put your money in there and it'll grow and you don't pay taxes on it. And then, your income will be lower even though you're having gains, and you won't pay extra tax on Social Security. You'll fall under the IRMA limit for Medicare. And so everything's great.
Until you
But it
take it out.
is until it isn't, right? Have you ever heard the term LIFO, Tony? LIFO?
LIFO?
LIFO? Isn't that your dog's name? No, LIFO. Sit, LIFO, sit. LIFO, last in, first out. It's an acronym. Last in, first out. So that's how annuities are taxed. So when you ultimately do take money from an annuity, non-qualified, it's going to tax the earnings first. And then it'll go to whatever your contribution was or the cost basis. That you get your money back tax free. So let's go back to the example. You put 100,000 in, Tony. Now it's worth 105 and you need 10,000. So you take 10,000 out of this annuity. The first 5,000 you take out is going to all be gains. And so you're going to get taxed on that. The next 5,000 is going to be a return of your principal or whatever you put in, and you don't pay tax on that. But you can't say, you know what, keep the earnings deferred. I don't want to pay taxes on it. Just give me
Right.
10,000 from my principal. Doesn't work that
Wouldn't
way.
that be awesome?
Yeah, that would be FIFO, first in, first out. And that's not how annuities work. So
Right.
annuities are by law LIFO. And people don't realize that. And it gets complex because it's all right, Tony. What if you said, I don't want 100, I don't want to take 5,000 out of the 105 that I have. I just want to take a lifetime income from it. So now you're going to get paid that 105 plus interest over your lifetime. And you're going to get, I don't know, let's just call it $8,000 a year. So you take 8,000 out. How is that taxed? That's different.
Oh, it is.
That has an exclusion ratio. So the insurance company says, all right, we're going to pay you over your lifetime. Here's how much is principal. Here's how much is interest. We'll pay you. There's a formula. You pay tax on the interest, not on the principal. So that's complex. You really would struggle to do that
Interesting.
on your own. You
Yeah,
have
how
to
are
have the
people
actuaries.
expected to know all this? I mean, without having a financial professional who's a trusted financial professional who can look at it and say, "Okay, here's the way it works. Here's how it's going to affect you." I mean,
Well,
that's a lot
technically,
for the
so
average senior out there. I mean, this is a lot.
right, and anyone can have annuities. I've run into a lot of people with annuities that they got in their 40s and 50s, which
Sure.
there's a tax penalty if you take a withdrawal from an annuity prior to 59 and a half,
Right.
very much like the IRA. Because annuities is supposed to be for retirement purposes or income,
Yeah.
but some people use it to grow as like, just to have
An
as
investment
accumulation
vehicle.
product.
Yeah. Yeah. Like a CD.
But they're not really good for that because of the 59 and a half rule.
Yeah.
So you associate seniors or people 60 and older with annuities because that's typically who get them. But the question is, how are you supposed to know all this? Well, technically, the person selling the annuity is supposed to explain all this to you.
Sure.
On the same token, you'll often hear, and this goes to a lot of financial advisors too, I don't provide tax advice. I don't,
Oh, yeah.
you gotta talk to your accountant about that. But buy this product because
Yeah.
it's great and it's tax free.
Yeah.
No, it's not. It's
Yeah.
tax deferred. You're right. Okay. Okay. But what does that mean? Well, what if I take it as a lifetime income? How is it taxed? You got to talk to an accountant about that. Well, you're the one selling me the product. You can't
Yeah.
tell me how it's taxed. I'm not a tax person. Well, who is? And then you go talk to your accountant and they'll be like, don't buy an annuity, right? Or they're
Yeah.
the devil, right?
Right.
Or your financial advisor will be like, oh, annuities are the worst, or annuities are the greatest thing. Like, but no one's going to step up and say,
Here's how they
help you
work.
with, right?
Let me help
Because
you. Yeah.
it's not easy, right?
But you've
But I'm
probably had
definitely,
people come to you with annuities and you look at it and go, "Holy cow, they got
yeah,
themselves into a bad does not fit their needs and is
right.
not good for them at all," right? Have you had
And the
that
reason why I'm
happen?
doing this show is because I've had that recently with a couple of people. Hey, I just found my dad had this annuity. Well, I have no idea how this works. Can you explain it?
Yeah.
Or they'll come to me and they'll say, here's my assets, here's what I got. And I'll see an annuity with a huge gain, not in an IRA. And they're like, I don't want it anymore. Let's just take it. And I'm like, well, first, you're too young. We'll get hit with a 10% penalty. Or if you take that whole thing, you're going to get hit with a huge tax bill. Why? I put in 100,000. Yeah, it's worth 160. So you're going to get $60,000 gain taxed. Well, they didn't tell me that.
Yeah.
So
Of course
so
not.
here's the thing though, Tony. Hopefully this, so this happens. So hopefully this will help somebody. They're the earnings on an annuity are taxed at your ordinary income, just like you would get from a CD at the bank, a 1099. You get a 1099 from the insurance company. And so you might be at a high tax bracket and you're like, well, I have gains over here, and you take it, you could be paying 22, 30% tax on this annuity, not capital gains. Well, I've held
Yikes.
this annuity for more than a year. I've held this annuity for a decade. Why aren't I paying long-term capital gains? Annuities are not taxed like stocks or bonds or real estate or basically every other investment. They're taxed as ordinary income, which is very important to know
Yeah.
because there's a huge difference between a capital gains tax rate and an ordinary income tax rate.
Oh,
It could
yeah.
work in your favor, but most of the time, you'd rather have long-term capital gains tax rate,
Oh, sure.
not
Yeah.
ordinary income.
Interesting. Well, and the tax implications are always something to take into consideration, and there are others, pros and cons. Like, yeah, I'm sure some people have come to you with variable annuities with really high fees
Sure.
and losses, and you're like, "How did you get into this? This is not good
Right.
for you."
It's
Right?
worth the annuity's worth more if you're dead than alive. I've seen that
Yeah.
a lot because the death benefit's so high, but the performance of the market and the fees, the actual value is so low that they're like, why would I ever surrender? Why would I ever get rid of this? And I'm like, you're right. It's kind of become a life insurance policy.
Yeah.
Um,
Yeah, but
but
there
it's not
are
tax
good
free.
annuities. Let's preface this with in some situations, I mean, there's a fixed indexed annuity that you can get where your principal's protected. You get to participate in some of the S&P 500 upside, maybe not full upside if it goes up 20%, but there are different caps on that between 5 and 15% usually. And those can be good in certain situations, right? I mean, not all annuities are
Yes,
bad.
and variable annuity could be good. Fixed annuity, indexed annuities, they can be good. I don't mind them. I'm not against them. It's just that the taxation of them is different than everything else, and people don't realize that until it's too late, usually. If
Yeah,
if
but you
your
have to make
IRA
sure
would
they
ever
fit
try to
into your plan. I mean, if you have other
right,
taxable events or you have other if all your money is in a traditional IRA and then you're like, "Should I have
it
this
it
or"
doesn't matter if it's an annuity or if it's in the stock market.
Yeah,
It's all taxed anyway. So
yeah,
none of this matters if an annuity is in an IRA.
right.
But once you have it outside the IRA, the tax differences are stark and very important to know.
But you can
And
have an
so,
annuity inside an IRA
yes, it's
because an
just like
IRA is
owning
just a
gold.
tax designation, right?
Right, right.
Yeah,
You can own real estate, gold, stocks,
yeah.
bonds, annuities, anything in an IRA.
Part of
Um,
Dolphin Financial, you could own that, put it in an
you can,
annuity or in
you
a
can. You'd
IRA.
have to be part owner, which you're clearly not. Let's be clear about that.
Yeah.
No matter what anyone's telling you.
Wait, you told me there was when I took this co-hosting gig,
But you do
I
own
was
you do own
promised
an annuity.
profit sharing. But you've
You
just
own
been
an
telling
annuity.
me this
I'll give
whole
it to you.
time I haven't been getting checks because there was no profit. How long is that gonna
They're
last? Come on.
they're deferred. Those are all deferred. You'll get them when you pass away. Speaking of that, passing away, that's the other thing that
You'll get
people don't
credit in
realize. And
heaven? Is that what you're
this
saying?
yes, this is a big, big factor for annuities that people don't realize. There's no step up in basis when you die. So let's say you have 100,000, Tony, and you put 50. Well, we'll say you have 200,000. You put 100 in an annuity and 100 in the stock market, and the annuity grows to 150,000 and the stocks go to 200,000. And then you die and you left everything to your wife. Your wife, the stock portfolio worth 200,000, she would inherit that, no taxes due. That's called a step up in basis. So she would inherit it at its $200,000 value, and she could decide to sell it or hold on to it, but she has to worry about the taxes from that point on, the day of your death.
Wow.
However, if you have the 100,000 that is now worth 150 in an annuity and you die and leave it to your wife, she's responsible for the $50,000 gains at her ordinary income tax rate. There's no step up. If you own a house, a stock, a bond, it's all stepped up. No taxes due on death. Annuities don't have a step up. So someone is going to pay taxes, whether you or your beneficiaries when you die.
Or
And
your loved
people don't
ones.
realize that.
Yeah.
So a lot of times I'll run into, hey, my dad has this annuity, my mom has this annuity, and she's got a good gain in it. Um, and I'm the beneficiary. What do we do with it? Do we hold on to it? There's got a huge gain, but it's not making anything. It's making 2% a year. I'd like to get more interest in the market. Well, you can't take it out of the annuity and buy stocks because your mother would have to pay tax on the entire gain at that point.
Hmm.
And it's like, well, I don't want to pay tax on it. Well, someone has to. So when your mom dies, you're going to be paying tax on the difference between what she put in and what it's worth. And that's a biggie. This no step up in basis is very, I would say, is a big con when it comes to
Oh. Yeah, I
non-qualified
didn't
annuities.
realize that. And so step up in basis, just really quick, clarify that for our listeners. So let's say I inherit my parents' home
Yes.
and I have that value, or I inherit money, or I inherit something like that, a value where step up in basis applies. How does that work
So
for
let's just use the
taxation?
home. Let's use the home. You
Okay,
inherit the family house, and they bought it for $10,000 in the 70s, and
sure.
now it's worth 400. Okay. We just did a show on how they're thinking about eliminating the capital gains tax on sales of homes. But on death, there's a step up. So you would inherit that house as of the date that they died at the value that it was worth when they died. So they died last week and you inherited the house last week and it was worth 400,000. Now you have a $400,000 house. And if you go to sell it, and let's say you sell it for 410,000, you're only responsible for 10,000 of taxes because there's a step up to 400 when they died. Same with a stock. You inherit Apple stock worth $1 million, and your parents bought it for $10. Oh my God, I owe tax on $990,000. No, you don't owe tax on anything. When they die, it's worth whatever it was when they died. You pay tax on anything above that. Now, if it's an annuity, same thing. They put 10,000 into annuity. Now it's worth 400,000. Great annuity. Whatever, sign me up. But odds are it won't be that high. But let's say it is, you would still be responsible for 390,000 of taxes. There's no step up to the 400 upon death. That's the difference. So a step up means that the value that you're inheriting it at is stepped up to the day of their death, not what they originally paid.
Hmm.
It's a huge, huge issue for non-qualified annuities,
Yeah.
especially for people that buy annuities, defer it, defer it, defer it, then they get a new one, defer that, and they keep kicking the can on these taxes, thinking that they won't have to pay. That's true. They don't have to pay until they take money out. But when they die, their beneficiaries have to pay. And usually the beneficiaries inherit it at a really bad time for them tax wise. That's just the way
Yeah,
it usually goes.
yeah, usually when you pass, your kids are probably in their peak earning years, right? Is what you're
Yes.
thinking.
Yes.
So then
Right.
they're gonna pay a huge that's gonna really
Right.
it's probably gonna put them into a higher tax bracket. It could, depending on the amount. Yeah. So I see what you mean, and the beauty of step up in basis is good. Wish everything had that. Or like you
Right.
said,
So
if you inherit a house, the no tax, that
right.
would be
No tax
awesome.
on stocks, bonds, any it's always a step up in basis.
Yeah.
And it's only good for the beneficiaries though. That's the problem. Step
Yeah.
up isn't good for you because you don't benefit from step up unless you
Yeah.
die
Yeah.
and you're dead. So what I often see is people say, "Oh, my dad's got the annuity, and the reason why he has it is because he's scared of the market, and this is a good, safe option for him." And it was pitched to him as a safe alternative that's going to grow and not lose value. And if the answer and if your dad's saying, "Well, I'm leaving it to little Anthony because that's what I want." Well, you would have been better off, if that's truly the case, buying a stock portfolio or a bond portfolio or something with a step up real estate, land that is a step up in basis to help little Anthony. Because if you don't intend to take it or sell it, why would you want to not capitalize on that step up in basis? And people just don't think about that.
Yeah.
They just look at the benefits while you're alive. And so, hey, I get it. Tax deferral while you're alive is great, but you're really only kicking the can. It's just like having an IRA. Someone's going to pay the taxes eventually.
Sure. And
So,
Little Anthony, the name of my autobiography, my future autobiography,
yes.
Little
I thought it was
Anthony.
Lil Anthony.
Lil
Lil.
Anthony?
Yeah, with the little
No,
apostrophe. No,
probably better not.
little Anthony.
Better not
So,
on that one.
speaking of another A word, the annuities that are outside of an IRA, they do have these specific rules that are different. You better know that. If you own an annuity or thinking about it, understand this and think it through. Think about the tax deferral, think about your ordinary income tax rates, think about the lack of step up, and then say, is it really make sense financially? Does it truly make sense? You can't just focus on the positives of an annuity. You have to focus on the tax issues that they bring to the table. So again, though, there's no right answer. I'm not against them. I'm just saying they could be good or they could be terrible. Depends on your tax situation.
And to
That's
find
how.
out if they're good or bad for you or what you should do, maybe one would fit your situation and be a good tool to use. People should pick up the phone and give you a call at Dolphin
Yeah.
Financial and get a plan in place or get a second opinion on where they're at or a first. And having a plan for these types of things and for retirement income is huge. So before we go, Dan, I know you don't like to do this, but I'm going to make you give out that phone number and web address. I know you don't want to turn your shows into an infomercial, but you really do help so many people all over the place. How can people get a hold of you?
The easiest is to go to dolphinfinancialgroup.com and connect with me online, or you call the number 888-508-5935. I've seen a lot of annuities, Tony, over my lifetime. A lot of times it's, hey, I have this. What do you think? I'm trying to plan out my retirement. I got this thing over here. What is it? And I wind up explaining to them what it is. Sometimes they're great. Like I've seen some annuities from the 90s that have ridiculously low or high minimums, in terms of interest. I'm like, well, we
Sure.
got to keep on to this thing. Don't get rid of that. Other
Yeah.
times I'm like, oh my gosh, I don't know why you got this. And they often say, yeah, I haven't talked to that person since they sold it to me. That was a regret,
Right.
But either way, you own it. You might as well figure out the best way to use it. It doesn't always mean you got to get rid of it, but you should maybe start planning for it. It's tax planning, and annuities have their rules. It's good to understand them. I usually spend a lot of time just explaining what they own to people, and then decide what to do from there. So yeah, that's
Sure.
the best way. So we'll end it there, Tony. Thanks for another good show, and we'll talk about that ownership of Dolphin Financial Group with you offline. All right, we'll
Yeah.
see it.
Little
And
Anthony needs his
yeah,
checks.
we may or may not see little Anthony next week. Have a good week, everybody.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.